Hi, good evening, everyone. Welcome to this another round of our webinar session where we want our speakers to come and we want our viewers to have an understanding about the mutual fund market and what's happening in the industry. So, welcome all of you once again. And today's topic is navigating debt mutual funds in bullish markets. As you all know that yes, right now equity market is at its peak. Sensex and Nifty is giving us surprises on a daily basis, and that is how we have seen the interest rates hike in the debt side as well. But sometimes we always get some confusion that what will happen to the debt market if equity will perform this way. So we thought there cannot be a better person than Mr. Marzban Irani, who is the CIO of fixed income of LIC Mutual Fund Asset Management Company, so to share his thoughts with us. I would like to take some couple of minutes to share something about Mr. Irani. Mr. Irani is our debt market expert having rich experience of 22 years in fixed income. He has played a vital role in building LIC Mutual Fund image of mutual fund of investor choice for debt funds. And Mr. Irani is a PGDBM, Chetan's Institute Management and Research, Mumbai, BCom Mumbai University. As far as experience is concerned, he has worked with before LIC, he's worked with DSP BlackRock as VP Fixed Income. He has worked as Senior Fund Manager Fixed Income with Tata Asset Management, Fund Manager Fixed Income with MetLife, India Insurance, Mirai Asset Global, and Tata Asset Management in the beginning. So, without taking much time, I would request Mr. Irani to share his valuable thoughts that what investors should think about his portfolio when he is considering fixed income to be part of it, so that in the current scenario, whatever changes everyone wants to do in his portfolio and to review his investment portfolio, what the investors should consider and what is the outlook of fixed income going forward. So, for that, Mr. Irani, I invite you to share your valuable thoughts. Thank you.
Thank you. Uh, should I put the so? Thank you all for coming. A big good evening to everyone. Uh, I'll just run through the slides. Just
Sure.
is it visible?
Yes, quite visible. Please go
Yeah.
ahead.
Okay. So thank you all for joining. We'll be covering the global scenario, then the Indian domestic scenario. What are the positives and concerns on the fixed income side, and the way forward? What we think should be done. Um, First, we cover the global scenario. So globally, two things have happened. One is on the rates. As we all know, US has hiked aggressively, but what they have not done is to suck out the excess liquidity from the system. Around during the COVID period, around 5 trillion worth of liquidity was infused in the system, but that was not really around 10 to 15% has been absorbed over a period of time. And the liquidity continues to be there. So that's why we are seeing some signs of inflation over there, and it is although it's declining, it's coming down a little gradually, and that's why we are seeing the rate hike. Next week we are having a Fed meeting, and a hike has been anticipated. So on the inflation front, the core inflation is above the target level. Whether you take US, you take UK, you take Eurozone. um, Eurozone, this was expected because during 2008 crisis also, there were no, after the crisis was over, the rate hikes didn't happen because they were like in the negative or zero kind of an interest rate scenario. So now they are facing that pinch, and they have to hike this time, because if they don't hike now, when the time to cut comes, I mean, they don't have any leeway to cut. So and the inflation has gone above the roof in all these places. um, Similarly, in as far as liquidity, as I told you, the liquidity absorption was a little slow in US, over a period of time, which was that has not really been absorbed. Also, the debt ceiling that we all know, they wanted to increase the ceiling limit, and after that limit has been sanctioned, around $800 billion has been raised. So, keeping all this in mind, there is a rate hike which we are expecting this month. Probably could be the last kind of a thing, and but we are not expecting the Fed to say anything negative at this point, because if they say this is the last hike kind of a scenario, then there will be immediate rally in the bond market. So they will say that it will be data dependent, and they will keep some watch for some time. And that is what they have been saying, that we'll look at past rate hikes, what we have done, what is the impact of that, and then we take further action from there. um, Past data indicates that whenever Fed has hiked like this, there is a hike kind of a cycle, then the rates remain at higher rate for, say, not more than a year or so. After that, they start cutting down the rates. So for some time, we may see these rates in next 6 months or so, we'll see these rates like this. And over a period of time, we'll see rate cuts. Because the next question which comes to investors is, when is the rate cut going to happen? So that is still some time away. It's not near, and we are still in the hike kind of a scenario, and then it will remain there, plateau out, and then rates will come down. The Fed fund implied probability, the FFIP, which is showing around 93% chance of a rate hike this next week, this month, um, is also showing that probably this is the last hike, and there won't be further rate hikes there at this point in time. And World Bank has also predicted a global slowdown. So I think they will consider all these things before they take any decision further. This is the inflation that we were talking about. It's 9% plus some time back in all the places, although now we are seeing that it is gradually declining over a period of time. So this is something that we have already discussed. The FOMC, currently they are standing at this 5 quarter, and we are expecting this to go to 5 half this month. And evidence of inflation is continuing. See, what has really happened is that in this cycle, the core is sticky around 5%. Their target rate is around 2%. It cannot come down so fast now, as we go ahead. So probably they will settle down at somewhere in between around 3.5%, and before the Fed starts, taking some decision on cuts or anything else. But it's not that it will go back to 2% very soon. It's going to take some time, and they will take some pause to assess the impact of rate hikes. Similarly, with ECB and Bank of England, I think the rate hikes will continue for some time. So that's on the global front. On the domestic front, our economy, that it's has been, there are a lot of positive signs. The resilient Indian economy, inflation touched around close to 4%, and then it has started rising to around 4.8, and the number which will come going ahead in the coming month is will be closer to 6%. That's because of the sudden shoot up in the prices of tomatoes and other things. But see, the central bank also knows that this is not a sustainable thing. Let me tell you, a month back, the farmers were just, agitated that the tomatoes are not even selling for 20-25 rupees, and they just wanted to throw away those, that produce. So, and currently we are saying that, there is no supply, and the price has risen to 150, 160, whatever, at this point in time. So this is not a sustainable thing. The way it has gone up, it has to decline. It has to come back to the mean reversion kind of a scenario. So inflation is not such a big concern. That is on food. Other things are okay. I mean, oil prices have not gone to that three-digit kind of thing. In spite of OPEC threatening that we will reduce the production, there will be production cuts and other things. Still, the oil prices, the crude oil prices have been lower. GST collections have been good, and the job creation has been good over here. Stronger capex, on the infrastructure and other things. Brent prices, as I discussed, in spite of OPEC sending these, production cuts and all these type of signals, still the Brent prices have been higher. Monsoon, after a lag, has picked up. In between, there was a slowdown in the initially when it started, but now it has picked up in a big way. I think people getting hassled to travel is a signal that the monsoon is good. But let me tell you one thing, that it is all about spatial distribution. And monsoon, people can't really predict, in April, May kind of thing, that it's going to be normal this year and other things, only by, say, mid end of July or end of August, we come to know that the monsoon has been good or bad. it's too otherwise it's too early to comment on monsoon. And at the moment it is, I think it has fulfilled the backlog. Lower NPAs is on the banking system that we have been mentioning, and debt has started after a long time. From April onwards, we have started seeing some inflows. Last month also, we have seen in June around 8-9 thousand crores of inflows in the fixed income market. So, so inflation we have already discussed on the domestic front. That inflation will continue to be high for some time this quarter, maybe 2-3 months, because of the food prices. But once the mean revision happens, the food prices decline, your headline inflation will also decline. Other things which are there in the on the core side, so those are also, will decline over a period of time on the inflation front. So, the key events that will impact the debt market as we go ahead, the interest rate, the growth, the inflation, and the liquidity. So, we don't see any interest rate changes from the MPC in the coming August policy or going ahead. I think MPC will be on close watch. They will closely watch the global economies, how things are shaping up. A growth at 6.5% is a decent number, and I think that's going to consumption will continue to give a kicker to that number. Inflation, RBI has indicated a 5.2%. However, we feel that inflation might be a little higher, say around 5.5% as we go ahead, because that's because of the food prices, and then it will, after September, October, it will start coming down. Liquidity, as I mentioned some time back when we were talking about the global scenario, that during the COVID period, they infused liquidity, but when the COVID got over, these guys didn't suck out the full liquidity which was infused in the system. But that's not the case on the domestic front. Our central bank has managed it beautifully. The excess liquidity which was there at that point in time was gradually absorbed by the central bank over a period of time. And the governor has been very vocal about it. Whenever there is a policy or some event, that we'll keep the liquidity neutral, we'll not keep it excess, we'll not keep it deficit, and RBI will keep intervening and keep the liquidity neutral kind of a scenario. In between, around 2 months back, RBI had announced the dividend which they give every year to the government. That dividend amount was huge compared to what it was previous year. This year it was 78,000 crores. But there was some, fertilizer subsidies which were given, and the government needed those funds. So RBI is very cognizant of that. They knew this money is going to go out, against that. So that liquidity is not going to come in the system. We were expecting that probably some other announcement would come to give some relief to the market. This 2000 note thing which came out some time back has given some respite, that money going into the system. So, what are the debt market positives, and what are the concerns at this point in time? First, the positives: further rate hikes on the domestic front are not expected, because that type of concern is not over here. As I told you, liquidity is also kept tight. Um, so there are no rate hikes at this point in time on the domestic front. Um, Urban demand is strong. Agricultural activity will show up over a period of time. Capex, government is putting in necessary, thrust on the capex, make in India and other things. The RBI projection for the growth number has been decent, 6% plus. So that is a positive thing. Decline in the rate hike pace over a period of time. As we, when US started hiking, they were hiking very aggressively, 50 basis points in one shot. Now that those rate hikes have either come to 25 basis point or a pause or that kind of scenario. So the pace of global rate hikes has also reduced to that extent. Otherwise, that would have also created some pressure on us. Inflation, as I said, will be in the 5 to 6% range, somewhere around 5.5, till for the next 2-3 months. That's because there's a sudden uptake in the food prices. External balance has been comfortable, and expectation of normal monsoon. This is at the moment, I think, as I mentioned some time back, when people in Mumbai, we say that when people find it trains are shut, or people cannot travel, because trains are the lifeline of Mumbai. So that is the time you have to understand that the rainfall has been sufficient. I mean, that kind of scenario. So that kind of scenario we are seeing at the moment gradually. What are the concerns on the fixed income side? The geopolitical uncertainties are there. We are surrounded by mischievous neighbors. The government is cognizant of that. The spending is happening on a lot of things, on the army and other weapons and other things. um, there can be a weakening in the external demand. World Bank has estimated that the growth all over the world, will slow down over a period of time. So that we can consider it as a risk over a period of time. And commodity prices being volatile, global financial markets, or currency risk, these type of things is what we are watching very closely as the risk as far as fixed income markets are concerned. So, what are the key events? Like, what are the things that we'll be watching as we go ahead? The global policies, uh, on the growth, or government or RBI policy decisions to support the domestic economy. We don't feel there are going to be major changes from the Reserve Bank at this point in time. I think the policy should remain more or less neutral in August and in October also. Geopolitical uncertainties, as I mentioned some time back, we are closely watching, and commodity prices also we are watching closely. If there is a sudden movement in commodity, India being a net importer of oil and other things, it impacts us. So we always closely watch the commodity prices. So what does all this lead us to? Investors, we normally tell them to, depending on their risk appetite, where they should be investing. Some investors have short term views, some investors have long term money. So what are the benefits at the short end of the curve? What are the benefits at the long end of the curve? So at the short end of the curve, the liquidity is there. As we enter into is neutral at this point in time, and as we go ahead, in next 3 4 months, we'll see RBI gradually. The first step will be to release liquidity gradually into the system. That is what RBI will do, and the rates will come down very fast. We have seen that the short end of the curve, the yields have moved up very. When I say short end, I mean 1 year, 3 year, even we have seen 5 year moving in a very sweet spot. So those are very sweet spots where there is money to be made. Over here, as I mentioned, the probability of rate hikes is also very low. FD rates till March were very attractive, and people were wondering, why should I invest in a 1 year mutual fund scheme compared to, say, a bank FD. So now I think those rates are also declining. Some money which was lying in liquid fund, because when there is volatility, people tend to sit in liquid fund for long. So that money is slowly moving into low duration gradually. If we see the numbers, that money is gradually moving there, because there is a 50 basis points better return in that category, accrual, sorry, in that category. And there are no lock-ins, unlike FDs where you are penalized. Here you can just come in, you can walk out anytime. Similarly, at the long end of the curve, see, a lot of people ask, because in 22 July we had launched a 10-year kind of a product at that point, and from there on the 10-year actually turned after 760. I remember in July 22, a lot of investors were asking that where will the yield go? Will it go to 8? Somebody was asking 8 quarter, and we had done some basic analysis, after Dr. Rajan had left, on inflation and what work he had done on inflation targeting, that how many time the yield has actually gone above 775, and most of the time the yield was below 775, around 85% of the time. So that is why we were very confident in July 22 that the long term yields will not, 10-year yield will not go beyond those levels. Although US is hiking rates, domestic rate hikes may also come, but markets are always ahead of all these events, and they tend to discount all this. So We launched some fund, a 10-year fund rolled down at that point in time. And today, 1 year down the line, people ask me that the fund has done good, but have we missed the bus? I'm still telling people that you are in the middle of the bridge. um, it's yeah, surely half the rally has happened, but half the rally is pending. So it's not that people have missed the bus or anything like that. And this is a good time still to enter into fixed income funds. So when we go to the long end of the curve, there are bond funds, having long term strategies. There are GSEC ETFs now for investors, where you are getting live NAVs every 3-4 hours. You are getting a live now. Expenses are low. There are no loads in any of these funds. Um, People who prefer banking PSU type of funds, there also the corporate bond yields are very attractive in the 740 to 7.5 kind of a range. And investors can continue to look at those type of funds when they are making their investment. So as we go ahead, inflation, as I said, will start gradually declining after September, as stocks of key items like rice or wheat, these are important because now that is one more option for us. Food imports have become very feasible now. On the monsoon front, the reservoir levels in the northwest region, etc., are above the statutory level. So that is a positive thing. Fertilizer and oil prices are much lower as compared to what they were in 22. So that is also a positive sign. um, Supply side intervention, from the government is there. Government is intervening at MSP and other things. There's a steady growth in India and comfortable external balance. All this makes gives confidence to investors to put their money in the on the fixed income side. Having said that, there are certain concerns like, as I said, as of today, monsoon looks good, but monsoon is very erratic. Um, in simple language, where the water should fall where it is required. Simple. I mean, it's like that. Basically, we call it spatial distribution. So monsoon should, by August end, we'll come to know that wherever it was required, did it rain over there or not. There is a broad-based consumer demand. There can be a broad-based consumer slowdown. That type of globally it can happen. That, as I said, the World Bank is estimating that the world growth may slow down. U.S. recession, if at all it happens. So these are certain things that we are closely watching. But having said that, I've been telling investors that you put your money as long as you can. Structurally, your interest rates are declining. You look at anything, you look at PPF, you look at Kisan Vikas Patra, you look at any fixed income thing. What we have seen, like my father would have done a PPF at 13,
Right.
14%, 12%. I have seen 11, 10%. Our children will see some different rate of PPF. So gradually, structurally, your interest rates are declining. There was a time when inflation used to swing between, say, 4% to, say, 14%. Today, that type of scenario is not there. Uh,
Sure.
uh, you know, Today, if even if your inflation goes, say, above 6%, people start complaining. I mean, it comes in the media and it remains there for long. Then, RBI has to give a reason. So all these things are there. So now it's all kind of range bound kind of thing. We are playing in a particular area. So with that in mind, I've been telling investors. Then people are asking, why are the yields going up? Yields are
Yeah.
going up because your government is borrowing for infrastructure, for medical. What we are spending compared to, I'm not even comparing to US, but say if we compare to the other emerging markets like China or other like ours, I mean, we are still half of what they are spending on all these medical and infrastructure and all these things. So that's why government is borrowing. So it is for a good purpose, it is for capex. So this type of yields you may not get to see. Your peaks are coming down. I've seen 9, I've seen 8% GSEC. We have seen 775. This time we saw a turn from 760. So gradually your peaks are coming down. So that's why people should invest as long as possible, depending on their risk appetite. So I think I'll stop here, and if you guys have any questions, then we can take them.
Sure. Thank you so much, Mr. Irani. I believe the crisp and a very brief presentation which you have showed that has given us macro as well as micro understanding how the debt market look likes. We have a couple of questions from various part of India, and I would say these are the questions which most of the viewers are having. That is it right time to invest in bank FDs, or one should consider debt mutual fund as one of the investment opportunity?
Yeah. Okay. So I think
I,
I
I
don't.
think investors are very much clear what they want to ask from the expert like you, so that they can take some investment decision in the right way.
Sure. So, see, the only thing is, like, I also I don't put my money in a bank FD. The reason being, only reason being that whenever I need my money, I don't need a penalty. I don't
Hmm.
need any bank to tell me that, suppose you've done a 1 year FD, and if you want your money after 6 months, I'll put a penalty to that and I'll give you a overnight rate. That doesn't happen in case of mutual funds. You can walk in anytime, you can walk out anytime. There is no penalty, there is no load. And as I mentioned, one slide, I was running on the short end of the curve, where I mentioned some of the benefits. If we can just 1 minute, I'll just put up that. So that will answer that question. Yeah. So liquidity is plays a very important role. Suppose if you don't do a 1 year FD and you say come in a 1 year low duration fund, then
Hmm.
as I said, the NAV of that fund moves based on liquidity. Currently, the liquidity is tight, no doubt about it. So that is why you are getting a very good accrual. A 735, 740. Those type of accruals are there. In the low duration type of schemes. So one can take those accruals, and when the rates actually decline, when the liquidity comes in the system, the rates will decline. So you will get capital appreciation also. So you will benefit in both the ways. And as I said, probability of rate hike on the domestic front is lower. Uh, uh, you know, uh, no good bank is giving you a FD rate, of 740, 7.5, or those kind of levels. And there is no lock-in, as I said. I want my money, when I want it. I mean, nobody should tell me that I'll put a penalty or something to that. So that is the biggest benefit as far as mutual funds are concerned, compared to, say, a bank FD.
And I believe for the people who are looking for fixed income as an investment, not only security and surety about the interest, liquidity definitely plays a very important role. And that is how traditional products like PPF or FD gets the lesser number of weightage in terms of low liquidity. Okay. Mr. Sagar is having a question that I am 62 years old and I am having 5 lakh rupees spare amount of money to invest. Whether to go for FD or debt mutual fund, considering uh, taxation as the core area. So
Okay.
from the
So,
taxation point of view, I think Mr. Rani, Mr. Sagar want to ask, considering the taxation changes in the debt after budget, so what should be the wise decision? Is it a comparative benefit in terms of FD or debt mutual fund, or there are other factors also to be considered?
yeah, since
So
I think
something on taxation, if you can just throw a light to us.
yeah. So, see, there was indexation surely before March, which was a big, benefit for mutual fund investors. That if you remain for
Yeah.
3 years, then you get the indexation benefit, and the more longer you stay, you get more indexations. That was the benefit available earlier. Now that benefit has gone. But that should not stop people from coming into, say, mutual fund schemes, because mutual fund schemes are actively managed. And if you look at the 3 year, 5 year kind of track record, because I'm
Yeah.
assuming that because of the age that you mentioned, it will be a little long term type of deposit. If you look
Yeah.
at mutual fund products, where fund managers tend to take active calls. I will give you an example in our case also. that when the COVID was almost over, like I'm talking about October, November 21, and there were no signs from the central banks. Although Fed was giving some indication of rate hikes at that point in time, there was no communication from the domestic central bank. But we
Mhm.
were clear that rates are going to move up, and we had cut down our duration. And now all the data is available online. You can go back and check all our schemes. Our 10-year, for example, our 10-year product, which is our bond fund, which is a 10-year product, we cut it down to around 2.5, 3 years. I mean, we brought it down
Mhm.
so low. My banking PSU, which is like a 3, 4 years, we brought it down to 1 year. So we
Mhm.
basically we cut down duration across our products to protect the investors' capital, so that when the cycle turns, the investor is not impacted. Similarly,
Right.
in by June, July 22, as I mentioned some time back, we increased the duration. We did the reverse because we were not expecting the rates to hang on high like this for long. I mean, it had to turn. So these type of active calls are taken by fund managers, and that is how we try to add value to the capital that you have invested with us. That may not, like in a bank FD may give you some anyway, that guarantees only till 5 lakhs. So if the amount
Yeah.
is above that, there is no guarantee in case of a bank also. It's better to be with a good, only thing you have to check before investing is the portfolio. You have to ensure that
Yeah.
the portfolio is very liquid, and so that you are not impacted in any way. Otherwise, I think over a period of time, the fixed income, in spite of this taxation benefit which has gone out after March, still the fixed income schemes will compete much more with the FDs.
Right. Mr. Rani, out of curiosity, I want to ask the secret of good performance of your fixed income funds of LIC AMC. So, what kind of investment philosophy you guys follow, so that some learnings can be taken by the layman investor also in their own portfolio decisions?
Sure. It's not a rocket science, but last more than 2 decades, I've been following this particular formula of SLR investments: safety, liquidity, and returns. Safety is
Yeah.
of paramount importance. When people give us money, their capital is of paramount importance to us. If we, for some reason, if we goof up there, if one credit goes
Yeah.
for a toss, I mean, in this country with the legal system and other things, to
Yeah.
recover that money becomes a big challenge. So we are
Yes.
very conscious about the safety part of it. um, on the liquidity also, we are very conscious, because we are a pass through vehicle. If the investor comes and tells me someday, all my investors come and tell me someday that sell all your papers and return the money that we have invested, then
Mhm.
I should be in a position to liquidate that. What we do is that regular intervals we keep trading in the secondary market. My fund managers, my traders, they keep taking quotes in the market. When you put 1 feet in the water, you know how deep it is.
Yeah.
That is how they come to know if they are trading, and my traders don't get any bids on a particular day. They immediately, that is like a signal that the liquidity is becoming tighter, and one should be
Mhm.
very alert about this type of situation. So liquidity is also of paramount importance to us. And returns, obviously, once you follow safety and liquidity, your returns, risk-adjusted returns, are bound to follow after all these things. So SLR is the philosophy that I've been following, and both my fund managers at the short end of the curve, at the long end of the curve, follow this to add value to the investors' money.
Great, great. Any recommendations for the category point of view, that what should be the category focus, or for the debt side, for the keeping in mind 3 to 5 years of horizon in mind?
Around 5 years.
Yeah, around 5 years.
Okay. So, see, this sweetest spot on the curve, as I mentioned some time back, is in the 1 to 5 year segment. Banking PSU is a category, where the funds are run more or less in the 3 to 4 years kind of category. One has to look at, the all that data is available online, depending on which fund house one is looking at.
Sure.
So that is, in our case, we run around 3.5 years kind of, between 3 to 4 years kind of maturity in the banking PSU category. I think that's a good option to for investors with little long term money, because that will be stable also. 3 year, there is not much volatility which happens on either side, and the
Yeah,
investor and the papers that are bought, as the name suggests, the banking and PSU, one cannot go beyond that. So, and
true.
since we don't have so much of banking stocks which are liquid, I think most of the money goes on the PSU front in this category. So
Yeah,
investors can look at that. You will get a flavor of sovereign papers also, because regulator has made it mandatory for fund managers to invest say 10 to 15% in in the sovereign papers in each and every scheme.
right.
So
Yeah,
we on a safer side, we have around 20% into those safe assets, and rest all into PSU assets, and those are all liquid also. Plus they are at very high, very attractive yield at the moment. So if the investor is having that 3 to 5 year view, they should invest here. That is one thing. Second thing, 1 year, 2 year down the line, when the rates decline, say,
yeah,
and they come towards more towards six half, six quarter. So active calls are taken in these type of open-ended funds, where the fund manager can reduce the duration, and then again, when the cycle turns, then again go into little longer duration. So that active duration is also one more benefit into these type of funds.
I think you have said it very right that it makes sense that banking and PSU, considering 3 to 5 years of horizon, should be one of the flavor for the
Yeah.
investors should look at. Mr. Irani, I don't see much questions now, and I believe with the kind of presentation you have shared, couple of questions have already been covered in terms of global outlook and how the geopolitical environment will play the role in coming times to for the economy, and plus Fed rates, how the impact will be in case Fed take any decision on the upward or downward side, where the chances are, of course, on the lower side. Uh, I believe our viewers have got a very good insights from the valuable talk we had right now. And with this, I would like to thanks LIC Mutual Fund for taking out time, and Mr. Irani for you specifically, so as to make a very simple and crisp presentation for our viewers who are very keen to learn about the market outlooks, especially fixed income in the current season. And thank you all your viewers also who has taken out time from their busy schedules to attend this webinar. We will put this recording on the social media and the YouTube and also the Bajaj Finance handle, so that those who have missed can also watch the video completely. And thank you so much, Mr. Irani. We would like to
Thank you, Mohit.
invite you sometime soon so that we
Sure.
can have better view on the upcoming market scenarios in the fixed income side. Thank you, everyone. Thank you,
Thank
viewers,
you,
and
Mohit.
thank you, Mr. Irani, once again. Thanks.